Hi everyone, glad you're here. Today we're diving into a company you might not know, but whose products are everywhere. Wanhua Chemical, a Chinese giant hiding in plain sight. Think about it, the foam in your mattress, the padding in your car seats, insulation in buildings, your sneakers, even part of your phone battery. Chances are Wanhua is behind it. Right now, the company is facing headwinds, a classic cyclical downturn with weak demand, compressed margins, and a sharp drop in stock price. So here is the question: could this be a buying opportunity for long-term investors? To find out, here is how we'll break it down. First, we will explore Wanhua's business model and industrial foundations, what the company does, how it's structured, and where it came from. Then, I will dig into its financial performance, from revenue and margins to debt and cash flows. After that, we'll look at its valuation, both in absolute terms and relative to peers. And finally, I will wrap up with my personal take on the stock, including the key upside drivers and downside risks. Quick disclaimer before we begin: this video is for educational purposes only. It's not financial advice. So always do your own research before investing. You're responsible for your choices. Let's start with what Wanhua Chemical actually does. It's a Chinese B2B chemical company whose materials are sold to industrial clients. Since these are intermediate goods, Wanhua's name isn't known to end consumers, but its products are part of their everyday lives. Wanhua operates in three main segments. Firstly, polyurethanes, including MDI, TDI, and polos, the key ingredients in foams for furniture, construction, and cars. The global market for these products is expected to grow steadily, from around $88 billion in 2025 to about $125 billion by 2034. That implies a compound annual growth rate of 3.9%. Secondly, petrochemicals like olefins, ethylene, and propylene. They are essential building blocks used to make plastics, packaging, textiles, and countless everyday products. And demand for these materials is also expected to grow steadily over the next decade. For example, the global ethylene market alone is projected to reach over $329 billion by 2032, up from around $2,020 billion in 2025. That's a CAGR of nearly 6%. Propylene and olefins are also on a solid upward trend, driven by their wide industrial applications. And finally, specialty chemicals and advanced materials, such as TPU, PC, PMMA, various resins, and battery materials. They are used in high-value industries like automotive, electronics, and energy storage. Wanhua runs a large-scale, fully integrated industrial complexes, and that's core to its model. Take MDI production. It starts with benzene from oil refining. Wanhua buys it, turns it into aniline, then into MDI using phosgene, which is also produced in-house. So from feedstock to final products, Wanhua controls the full chain. This deep integration is a real competitive edge, with tighter cost control, secure supply chain, and a greater operational flexibility. a major strength globally. Let's talk about the company's industrial footprint. The main production hub is in Yantai, handling olefins and MDI, fully integrated. Ningbo focuses on polycarbonate, TPU and TDI. Futian launched a new facility in 2023 for PVC, MDI and TDI. Meishan is dedicated to bioplastics like PBAT and battery materials. In Europe, Wanhua owns the Bosotem complex in Hungary, a long-time producer of MDI, TDI and PVC. Now it's European base. And finally, a new site is currently under construction in India. So how did all this start? Wanhua was founded in 1998 in Yantai, evolving from a state-owned factory, the Yantai Synthetic Liver Factory. From the start, it focused on MDI, entering a market then dominated by BASF, Bayer, now Covestro, and Huntsman. The company went public in December 2000 in the Shanghai Stock Exchange. It's not listed in Hong Kong. Actually, 52.8% of the shares are freely traded, and the rest is held by state-affiliated entities. In 2013, it rebranded as Wanhua Chemical Group, reflecting its expansion beyond polyurethanes. And finally, in 2019, the company acquired Bosotem in Hungary, boosting its European presence and capacity in commodity chemicals. Today, Wanhua is a global leader. It controls 20 to 25% of the global MDI market and is also a key player in TPU and polycarbonate, competing directly with BASF, Covestro and Huntsman. Its edge comes from deep vertical integration, large and modern industrial parks, and a very competitive cost structure, especially in MDI. It also benefits from China's national industrial strategy, which indirectly boosts its competitiveness, especially against Western players. That said, Wanhua remains dependent on raw inputs like benzene, natural gas, and propane, all tied to volatile oil and gas prices. So, when input costs rise, Wanhua can pass some of it on, but not instantly. There is always a lag. And when demand drops, prices fall fast, while input costs adjust more slowly. That's what makes Wanhua's margins so volatile. In short, there is a timing mismatch between rising costs and falling prices. And that's a key risk in its business model. Now a word on governance. Wanhua CEO is Ko Guangwu, age 59, in place for over a decade. The chairman and party secretary is Liao Zhengtai, age 60, with the company for more than 20 years. So let's start with the top line revenue. We can see that over the past 10 years, Wanhua's revenue has grown significantly. It hasn't been a smooth ride, which is normal for a cyclical business, but the overall trend is clearly up. From 2014 to 2024, revenue grew at a compound annual rate of 23.5%. That kind of sustained growth over a full decade reflects solid industrial expansion and strong positioning in key markets. Now if we break that revenue down by business segment, we can see that Wanhua's structure has changed quite a bit. In 2014, polyurethanes dominated Wanhua's sales, but by 2024, their share had dropped significantly, while petrochemicals gained major ground. That shift shows how Wanhua is actively diversifying beyond its historic strength in MDI, building a broader chemical platform. That's the breakdown by product. But what about geography? Let's take a look at where the sales are actually coming from. Geographically, China still accounts for the majority of sales, around 57.2% in 2024. But that also means 42.8% now comes from international markets, a clear sign of Wanhua's global expansion and efforts to reduce reliance on its home market. Now let's zoom in on one core product, MDI, which has historically been at the heart of Wanhua's business. By 2024, MDI prices had returned to levels seen in 2014, or even slightly lower. This drop reflects weaker demand and overcapacity in the MDI market, which has put pressure on prices. It's a reminder of just how cyclical and exposed this core product remains in Wanhua's model. Of course, price trends directly impact margins, so let's take a look at how profitability has evolved over time. Gross margin, that's revenue minus direct production costs like raw materials and energy, gives us a sense of profitability before overheads. We see a clear erosion here, from around 30% in 2014 to 26% in 2024, despite similar MDI prices. That drop likely reflects structural pressure from rising competition, and that decline in gross margin isn't an isolated case. We see the same pattern when we look at broader profitability metrics. The EBITDA margin, which gives a clearer sense of how efficiently business runs by including things like logistics, salaries, and overhead, dropped hard, from 21.5% in 2018 down to just 11.8% in 2024. Now break it down by segment, and the squeeze is visible across the board between 2018 and 2024. So polyurethanes from 31.6% to 26.2%. Petrochemicals from 10% to 3.5%, and specialty chemicals from 31.3% to 12.8%. So even as the business diversifies, all segments have suffered margin compression, the combined result of weaker demand and fiercer global competition. Let's now look at earnings. We can see a strong growth in earnings per share, but also clear volatility, which is pretty typical for a cyclical industry. On average, earnings per share grew by 16.9% per year over the past decade. That's a solid track record, especially considering the ups and downs along the way. Now, behind those earnings, there's been a lot of long-term investment. Let's look at capital expenditures and how Wanhua has built up its industrial base. Given how capital-intensive this business is, Wanhua has consistently reinvested. Over the past 10 years, capital expenditures averaged around 10% of revenue, a significant amount. For shareholders, this long-term investment shows up in one key metric. Industrial assets per share have increased steadily. So all of that investment has to be financed somehow. So what does the balance sheet look like? Net debt has risen steadily, which makes sense given the scale of investments. But the leverage ratio, net debt to EBITDA, has stayed under control, below 3 for the whole period and just 1.6 in 2024. That's a healthy level by most standards. Now let's turn to working capital, specifically days of sales. This tells us how many days of sales are tied up in inventories, receivables, and other short-term needs. Higher numbers mean more capital locked in and more strain on cash flow. In 2020, during COVID, working capital jumped to 63 days, mainly due to inventory buildup and slower payments. By 2024, it had normalized back to 36 days, close to the 2014 level, and much healthier overall. So with working capital back under control, how's cash generation holding up? Well, if we look at free cash flow per share, the trend shows that despite market volatility, Wanhua keeps generating a solid amount of cash. Money that can go toward dividends, paying down debt, or being reinvested into the business through capex or strategic projects. In 2024, free cash flow per share moved up again, but not because profits improved, it's mostly due to a sharp drop in capital expenditures. So, this is not a sign of booming earnings, it's more about disciplined spending during a tough part of the cycle. That's the story over the past decade. But what about the most recent numbers? Let's take a quick look at how the year 2025 started, just to see where things are heading in the short term. In Q1, revenue was down 6.7% year-on-year. Net income dropped even more by 26%. And an annualized return on equity was around 12.8%, well below historical norms. So far, there is no clear rebound. Weak demand continues to weigh heavily on both sales and profit. Actually, the company doesn't do share buybacks, but it does pay dividends. So let's start there. Over the past decade, Wanhua's dividend payouts have mostly followed earnings per share. And in 2024, the payout ratio remains conservative, just under 25%. At current prices, that translates to a dividend yield of around 2.3%. So it's not a high-yield stock, but Wanhua is still distributing part of its profit without straining its balance sheet. Beyond dividends, another key indicator for long-term investors is return on equity. It shows how efficiently the company turns shareholders' equity into profit. A high or stable return on equity usually signals strong capital allocation and solid operational performance. A drop, on the other hand, can reflect weaker profitability or inefficient capital use. Looking at Wanhua over the past decade, return on equity has been volatile, which is normal in a cyclical business. But even during down cycles, like now, it stayed above 10%, which is actually a strong result. That resilience is a good indicator of the robustness of Wanhua's business model. Now let's take a step back and look at how the stock price has evolved and how it compares to its long-term trend. Over the past 24 years, the red regression line, which shows the stock's long-term trajectory, reveals an impressive annualized growth of plus 19.4%, excluding dividends. That's a strong performance for a chemical company. You'll also notice the dotted gray lines above and below the trend. These are the standard deviation bands, which reflect the average distance between each historical price point and the regression line. In simple terms, they show how much the stock typically fluctuates around its long-term path. And this is a highly volatile stock. The standard deviation is about 53%, meaning price swings have historically been very wide. Right now, the stock is trading 2 standard deviations below the regression line, which suggests it's significantly undervalued relative to its historical trend. The current stock price is around 53 RMB, while the long-term trend points to about 110 RMB. That's a massive gap, and it clearly reflects the down cycle the company is going through. In other words, unless something fundamental has changed, this kind of gap tends to close when the cycle turns. So the stock looks cheap compared to its historical trend, but is it actually undervalued when we look at multiples? In 2024, Wanhua is trading at an EV to EBITDA multiple of 10.3x. That means the market is valuing the company, including debt, at about 10 times its core operating profit. To compare, base chemicals typically trade around 7x, and specialty chemicals are closer to 13x. Wanhua sits in the middle, which makes sense. It is still exposed to cyclical bulk chemicals like olefins and PVC, but it's also growing in high-value areas like TPU, polycarbonate, and battery materials. So at 10.3x, the stock doesn't look especially cheap, but it's not expensive either, especially if you expect margins to rebound with the next cycle. So after going through the business, the operations, the numbers, and the valuation, what's the verdict? Wanhua Chemicals stands out as a heavyweight in global chemicals, with deep vertical integration, world-class industrial assets, and a leader position in MDI. Over the past decade, it's expanded into petrochemicals and specialty materials like TPU and battery components, showing a clear shift beyond its polyurethanes roots. But despite this diversification, Wanhua remains highly sensitive to the global cycle. With today's weak margins and the valuation sitting 2 standard deviations below its long-term trend, the market seems to be pricing in a lot of bad news. At 10x EV to EBITDA, the stock isn't obviously cheap or expensive. It's in a kind of holding pattern, waiting for a catalyst. So what could push Wanhua higher? A rebound in global industrial demand, especially in construction and automotive, a recovery in prices for polyurethanes, especially MDI, or for petrochemicals. Low current margins may discourage new investments from competitors, creating an opportunity for Wanhua to increase its market share in the long run. Growth in high-value segments like TPU and battery materials, reshaping the profit profile. And finally, a re-rating if macro conditions improve or Chinese demand picks up. So now, what could go wrong? Weakness in China's economy, especially real estate, dragging on demand. Structural overcapacity in MDI, which may persist even if the cycle turns. Execution risks, if Wanhua keeps expanding while demand stays low. Major industrial incident. Geopolitical or ESG pressures like Western decoupling or stricter environmental rules. And finally, rising input costs for oil and gas feedstocks that Wanhua can't always pass through right away. Wanhua is a high-quality industrial name, trading near what could be the bottom of the cycle. The fundamentals remain strong, and it's firmly positioned in multiple key markets. The current valuation may not scream bargain, but given the depressed margins and long-term potential, it suggests the market might be overly pessimistic. If you are a long-term investor with an eye for quality when it's out of favor, Wanhua offers a compelling setup. The downside might not be over, but the upside is in sight. And in a market that tends to focus on short term, Wanhua could be one of the first to bounce back when sentiment improves. Thanks for watching this analysis. If you found it useful, consider liking and subscribing. It really helps the channel grow. Feel free to drop a comment below, whether it's a question, an insight, or just your take on Wanhua. I'd love to hear it. See you soon for another deep dive.